Good afternoon and happy Sunday, everybody. Hope your weekend's been great. I want to take a quick look at Arbor Realty Trust. This was a viewer recommendation or request. So, this is a mortgage REIT, which, as you may know, I have in the past turned up my nose toward these kind of companies just because the stink from 2008 is still kind of upon them in a lot of ways. But because of that, and because of the current bank crisis that really isn't happening for the same reasons as the 2008 one, it's more to do with interest rate risk on long-term bonds. That's the reason, and depositors getting spooked and making runs on the banks. That's the reason for the current issues. Mortgages don't really seem to have a lot to do with it. However, because people are saying it reminds them of 2008, there's that link mentally, and companies like this that may be getting some sort of pricing residual friendly fire just because of that like kind of psychological link. So that may present some opportunities for value, which we're going to look at here shortly. Now, before we dive into the valuation, I just want to take a quick peek at this dividend. Now, this is a very high yield, so we might have to wonder, okay, is this safe? Is this getting cut? Is it well covered? So, first of all, we'll look at dividend growth, what the payouts have been historically. Okay, so prior to 2008, they were paying and growing that dividend, and you can see from the end of 08 into the middle of 2012, there's a period of 3 or 4 years where they did not pay any dividends. Okay, and that's that 08, foreclosure default crisis that was happening back then. Okay, now from 2012 onward, which is more than 10 years now, they have behaved essentially like a pretty stable, reliable dividend growth company. All right. So that would seem to indicate a certain level of safety. There's a saying in the dividend growth community that the safest dividend is the one that was just raised. Now, in addition to that, the safest dividend is the one that has a reasonable payout ratio that easily covers the dividend. Okay? And in this case, what you have is a little slide from the investor presentation where they show a little bit about that. So they brag about the dividend increases. They also mention that they have the lowest dividend payout ratio in the industry. The industry, in this case, probably being just other mortgage REITs. That's who they're comparing themselves to, I would imagine. 10 straight years of dividend growth, like we just showed, goes back to 2012. Now, 67% is the ratio that they pay out of their distributable earnings. Okay, so basically, that's how out of all the money that they have available to distribute to shareholders, they're only actually paying out 67 cents on every dollar. That means not only is the dividend apparently very well covered, it appears that there would be room to continue to grow it in the future, which is important if your goal with investing in this would be income, right? You want not only a high level of income, but you want a growing stream of income. And you don't want to have to do anything for that growth. You'd rather just have it happen passively. So that's good. But what about the valuation? Now, it seems to me that the most logical way to value a mortgage REIT would be similar to a bank, in that you would probably want to do a price to book, or more specifically, a price to tangible book. So the calculation for that would be to take the shareholders' equity, all right, in this case, about $2.9 billion, subtract the equity attributable to preferred stock, in this case, 630 million. And also, since we're talking about tangible book value, to subtract the intangible assets, in this case, $96 million, okay? Which, since I already did the math earlier, came up with a tangible book value of about $2.2 billion, okay? So the market cap here is an even $2 billion, okay? So that means it's roughly a 0.9 price to book, or roughly a 10% discount, all right? Which would mean that the fair price would be somewhere in the low 12s, 12.20-ish, 12.25-ish, okay, on this stock per share, all right? And that's just based on like my rough calculation there. Sorry if I'm off a few cents or something, but that's gonna put you probably in the right ballpark of what most like if a value investor or an analyst or whatever was going to run like a price model on this, that's probably what they would list as like their target price. So now I do wonder what a dividend discount model would show for this thing, with the fact that it's starting with beefy double-digit yield with consistent growth over the last 10 years, and probably a good amount of growth in the coming years. Curious what that would come out to on a dividend discount model, but from a pure like classic, old school price to book basis, it seems like it's slightly undervalued, and the dividend appears to be well covered and relatively secure, and probably pretty likely to keep growing. If I had to take a guess, it seems like management is placing a lot of emphasis on that payout ratio and their ability to continue to pay and or grow this dividend. So those are just my initial thoughts on this. Don't forget, give me a comment if you are interested in this stock, or if you maybe have another take on it. Give me those likes for the algo. Subscribe to the channel if you want more videos like this. I love doing videos based on your requests. It's what gets me up in the morning. And anyway, have a great rest of your weekend. Peace out.